Most traders lost money on this move, and honestly, it wasn't because the setup was complicated. It was because they reacted emotionally. They saw price pushing up. They felt the FOMO, and they jumped in long, right before the drop. The market didn't trick them. Their emotions did. Let me walk you through what was really happening here. So first, let's start from the left side of the chart. The market is clearly bearish. We have lower highs, we have lower lows. Structure is clean. And when structure is bearish, my bias is simple. I'm not looking for buys, I'm only looking for shorts. I don't fight structure, I align with it. Now watch this. Price breaks a previous low. That's our first break of structure. Sellers are in control, momentum shifts lower, then we get a pullback. That's normal. Markets breathe, but after that pullback, price drops again and breaks structure a second time. Now we have two bearish breaks of structure. That's continuation, that's confirmation. This market wants lower prices. Now here's where most traders get trapped. Between these two breaks, price starts pushing up. Strong bullish candles. Looks like a reversal, right? That's what most people think. They see green candles, they feel opportunity, they go long, but look closer. Price pushes above the short-term highs. That's not strength. That's a liquidity sweep. Stops above those highs get taken. Breakout traders get filled. Buy-side liquidity gets collected. Smart money doesn't chase breakouts. Smart money hunts liquidity. And once that liquidity is taken, price forms a bearish order block. This is the last bullish candle before the strong move down. This is where institutions likely place their sell orders, but I don't enter immediately. I wait. Discipline is everything. When price comes back into that order block, I drop to a lower time frame. Now I'm looking for confirmation. A small break of structure to the downside, a strong bearish rejection, clear momentum shift, no confirmation, no trade. Once I get confirmation, I execute the short. Now let's talk risk. My stop loss goes above the order block or slightly above the liquidity sweep high. If price breaks that level with strength, my idea is wrong and I'm fine with that. Small controlled loss. Now target. Look at the bottom. Equal lows. Sell side liquidity sitting there. That's the magnet. Markets move from liquidity to liquidity. That's my take profit. I risk 1% per trade, maximum 2%, and I aim for at least a 1 to 2 risk to reward. 1 to 3 is even better. So this isn't guessing. This isn't prediction. This is structure. Bearish trend. Break of structure, second break of structure, liquidity sweep, order block, confirmation, entry, target at sell side liquidity. Simple. If you trade emotions, you become liquidity. If you trade structure, you take liquidity. That's the difference.